Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated with those, or even some markets that aren't but still have an impact. And we've had quite a continuation of volatility here. As we record, again, we could claim another new all-time high. I don't know how many times we're going to say that in 2024 as we step up here. Miles, without further ado, let's take a look back on the week.
Yeah, Tori, usually when I'm looking at the weeklies, I kind of like to look at where did we end our recording last week, Wednesday afternoon, maybe Thursday morning, to where we're doing our recording this week, the following Wednesday. Well, just for fun, because we did have a Fed announcement and quite a bit of market movement, I'm actually going to cheat a little bit just to extend the numbers out, just because it makes it a little bit more interesting. So we're going to take a look at where our lows and our highs were over the last week, because I think it's worth taking a look at this range we've seen across the board in a couple different metals. Starting with gold, following on the heels of the Fed announcement last week, the decrease in the interest rate, we did get some volatility in the gold price, but from bottom to top, you're looking at about a 122 point move. $122 move, about 4.8% there on gold. Silver, $2.50. That is about an 8.5% move. So silver had a heck of volatility last week, finishing out stronger than anybody else, up over $32 at one point. Platinum pretty even, and palladium dead even. So platinum up about $19. That's about 1.9%. And palladium almost flat even on the whole week, not really going anywhere. It had a range of a couple percent from top to bottom, but ultimately palladium pretty much dead even, down for the week slightly, but not too much movement. So kind of follows the idea that this is a monetary reaction, not a commodity reaction. Or at least that's what I'm getting from the precious metals. So I'm curious how maybe some of the other commodities that we want to take a look at, see if we see kind of revealing pattern. Do we see some consistency, or is there some divergence to the pattern of a relatively tame week in commodities, but a big week for the monetary metals?
Yeah, Miles, I think last week when we were recording, it was obviously Fed Day, and we warned not to put too much into that single day price action, but to see how everything reacts in the days coming. And I think the reaction was fairly clear. 50 basis points had kind of been whispered right before the Fed announcement. I don't know that anybody was sure they were going to do it. They did it. And you saw your inflationary assets kind of start reflating, right? That's the jump in silver. You had a big jump in copper. White metals, palladium and platinum, you just stated. WTI kind of did the same thing. An initial pretty big spike, and now it's kind of round tripped right back to where we were just before the Fed meeting. So I think overall, it will put a little bit more inflationary pressure on the Fed by cutting that way. But it does seem that it's shifted us from a macro perspective of we were in a time of deflation from the end of May, beginning of June. You saw all commodities kind of compress. Silver, big drop from its highs. WTI, copper, all of them did. And I think you're going to continue to see those reflate as we have.
Yeah, it does look like it's forming a base, and it'll be fun to see the time frame and how it corresponds to what the equities markets are doing to me as well, because, we have almost this coin toss of whether or not the rate cuts are going to do anything. Well, first of all, you've got potential additional rate cuts this year. They're now talking about another 25 basis points in November, 25 more in December is kind of the talk on the street now. And that would pull us off a full 1% by the close of 2024. So we have to withhold some judgment, but it's a really interesting dynamic of what transpires after a rate cut that matters most, because it's whether or not we go into a recession. So rate cuts can be very stimulative if there's no recession. So in the 6 months following a rate cut, you can see on average about a 15% rally in the equities markets. And that would be an indication that they've reignited inflation to me, that the commodities would likely follow. Correct me if I'm wrong in that thinking. Mm-hmm. The flip side is that if we do end up going into a recession, in the 6 months that follow those rate cuts, you'll see a recession kick in and the equities markets are down on average 15%. So it may be that they're literally unsuccessful and stimulating adequately, but that they're trying to get on the front end of this event that they see happening. I hear a lot of talk about the fact that they're cutting now so that they can raise again when they need to, if in fact inflation does run. This is kind of like putting arrows back in the quiver, and we just don't know. But here's a good image of what has transpired in the past with either a subsequent recession or an avoidance of recession, soft landing versus hard landing.
And I think an important note is we're focusing on the effect of what the Fed does with the interest rate directly to equities and to the gold price. But Miles came across some interesting information of how this might be a lot more correlated to the real estate market.
Yeah, this goes out to my client, Mark. So, Mark, I know you're listening. I appreciate all the research you did for me this week. So thanks for the emails that got passed around the office. Yeah, great quote coming out of Fannie Mae. The newly released summary of economic projections implies another 50 basis points in cuts by the end of 2024. So that's a lot in the next couple, that's 2 months. 3 months, October, November, December, another 50 points, and 100 basis point cuts through 2025, and as much as 50 in 26, reaching a terminal target rate of 2.75 to 3. So that's what Fannie Mae is calling for. Fannie Mae doesn't have a clue, let's be honest. That's what Fannie Mae is hoping for. They're hoping for resuming what they would consider, I would call modern normalcy, modern scraping zero interest rates within the real estate market across the board, because the crisis right now isn't in the S&P. Like I'm looking at the S&P last week jumping up 120 points, 2.5% from the rate cut announcement, which was expected, and then parking there. And we're looking at gold jumping up 50, 75 points, and then going up another 50 over the next week. So the markets themselves are reacting accordingly to the interest rate decline. We were going up when interest rates were going up, and now we're going to go up even faster when interest rates go down. So where is the call for the interest rate decline? Like what market needs it? And it has to be the real estate market because it's suffering out there. And Tori, when we were talking about this before the show started, it isn't just the residential market. The commercial market, I think, is just a whisper away from shambles.
Well, I'll tell you the disgusting part of it. Eric, you and I spoke about this week, is the effect on the middle and lower class.
Yep.
And where they'll come out and they'll say that, hey, this is making it affordable for people to borrow. Why is it so important for people to go further into debt? It's disgusting because this is a wealth transfer actually the opposite direction. It goes from the lower middle class to the upper 1/10, and even 0.01%, where, yes, Fannie and Freddie, it is very stimulative to your market. Same with the commercial market. Yes, another winner is the government in terms of the debt service on the debt that we already have. Anybody that's in debt that's in a variable rate type of a loan, it does help them. But you've got people that are maxing out credit cards. They're already living on credit because life got so expensive. We're not in a deflationary market here. And by the way, gold does very well in severe deflationary downturns if you're worried about your gold turning down, and we do see a deflationary market. Deflation means prices are getting cheaper. It doesn't mean that they're getting more expensive more slowly. That's the market we're in right now. Go to the grocery store, Eric. We were talking about this too. It's incredibly unaffordable for an average family to walk out with a week's worth of groceries. And that's the part that upsets me, is stop driving the credit markets and start stimulating the economy and wages in a sense. And I'm not trying to get political here, but I'm saying, so what if they lower rates? Yeah, you want a bunch of people to refinance so they can go further in debt by taking out a home equity line of credit and pay for the debt at a lower rate that they've been racking up over the last 2 years. To me, it's criminal, it's unethical, and it is not a problem solver. It's not solving the problem. And unfortunately, people have to sell liquid assets as store of value like their gold because it's their only liquid asset. It's a means of exchange, certainly, but it's a savings that they're tapping into.
This middle class issue with the ability to afford housing has nothing to do with the interest rate. It has to do with the underlying price of the house. Maybe that's right. Where I will get political. Mm-hmm. This isn't an interest rate problem. This is a Blackwater problem.
But it's across both sides of the aisle. You can get as political as you want. I mean, we're not talking one side versus the other. This is a continuation of look at single family home prices. Eric, you've done a great chart on overlaying gold versus single family home prices.
Yep.
Let's put that up here. So
Right. And I think the bigger problem is that once upon a time, single family homes were just that. They were made for families to live in. Now they're part of a portfolio. And unfortunately, the rate cuts and all of that stuff, that doesn't help me. A 50 basis point rate cut, okay, that just made a mortgage on the average house that I live in, it took it from, let's call it $8,000 to maybe $7,000 a month. That's not affordable. Who it does help is BlackRock, right? They can just keep levering up, and the home prices aren't going to go down, which is probably a big reason that through the largest increase, most severe interest rate hike increase we've seen, from 0.5% to 5.5% in such a short amount of time, didn't affect the home prices.
that's right.
They didn't go down. They actually
No.
kept going up.
Yeah.
No, we had to give it time and we didn't give it time.
No, it's gone from shelter to investment,
Yep.
right? And
Yep.
it's not just homes, you guys, it's across the board. And that's why I think it's important to overlay the gold chart. Take an asset class, take food, take fuel, take any of it, overlay the gold chart, and it'll scream
Yep.
why you own gold,
Yep.
right? Because it does make you immune to that stuff. But unfortunately, you had to be on the front end of that in a sense. Yes, gold is at an all-time high. Guess what? We're going to be talking 10 years from now, looking back on where prices are right now,
Yep.
shocked that we could get it for under $3,000 an ounce. Remember when?
Well, how about this? I started at this company in 2016, not very long ago. Gold was $1,100 then. We talked about, wow, what if it crossed 2,000? Now we're almost at 3,000. But
Yep.
in the grand scheme of things, it did exactly what it was supposed to do. Because as all of those prices of all of those assets got hot, gold just continues to maintain that purchasing power. That's why, Miles, you and Kev, I mean, how many times do we have to hear Kev talk about an ounce of gold buys you a loaf of bread for a year? Always has, always will. That's the point of it. That is the point.
Loaf of
That
bread
is-
a day.
A
Yeah.
loaf of bread a day for
sorry,
a year,
yeah.
and unfortunately, a loaf of bread, as Eric was just telling me 2 days ago, real bread is over $8 a loaf.
Yeah, this is brutal. And I do have to preface, my wife's a little bit of a hippie, so it's all organic food. But went to the store yesterday. I'm not usually the one that goes to the store. She asked me to get 2 loaves of bread and orange juice. I'm like, okay, no problem. The bread is made at the bakery there. So again, a little bump in price. There's a little premium
Real
there.
bread, 'cause
Yeah, but
it's
it's
real.
real, right? Like I can't feed my kids Wonder Bread, okay? So I get the 2 loaves of bread and I get the Matt's organic orange juice, which again, I know is a little bit more expensive. But those 3 items, $31.95. That's what it cost me.
Yep.
$31.95 for 2 loaves of bread and some orange juice.
And the travesty would be if you're having to sell gold in order to do that. Yes, it's going to exchange because you bought that gold back when that grocery bill would have been half that amount. And it means that your gold has doubled.
Yep.
So the protection is there. We just don't want you having to sell it here.
Yep.
My message is don't buy into the hype. Do not go borrow and increase your debt situation, because debt over time accumulates just like interest rates accumulate over time that work in your favor on return on investment.
Yeah.
The debt will work against you in a catastrophic way. And that's why we're talking about limits on credit card interest rates and everything else, because that's so suppressive. And again, look at it as a wealth transfer. If you're not saving in gold, you're feeding the Wall Street monster. If you're borrowing just because interest rates came off 50 basis points, you're feeding the Wall Street monster. If you're buying a house, you're feeding the Fannie Mae, Freddie Mac monster
Right.
that wants the rate cut.
Yep.
Don't buy into the hype.
Well, and for those of you who know me, I'm the least political and conspiratory person, but this does just ring of the you'll own nothing and be happy. Because guess what? If you don't own anything already, this is tough. This is tough. And it's getting harder and harder and harder. And the separation is getting wider and wider and wider from middle class to upper class.
And the 3 of us are going to do a show in the coming weeks on the effects of the election on the gold price. We keep getting asked, what's gold going to do if the Harris-Walz team wins? What's gold going to do if the Trump-Vance team wins? What do we see prices doing? And we'll do a whole show on that. Okay, we'll go do a retrospection. Miles is already digging into charts. Eric, you're already on it. And it'll be very, very thorough. But this is a long-term problem that's not a microcycle type of an event. So fun to see this type of volatility in a week. It's great to see your gold and the positions that you took help keep you immune. Think of it as a vaccine or something on your portfolio, or your cash position anyway, with maintaining that purchasing power. But please hear me, the news is bad. That's why gold is doing what it's doing. Now, we have a lot of potential in silver. Miles, I don't know if you want to get a little bit deeper into the charts now that we're pontificating so long, but now that we've hit these highs, I do think it's always important to say, where do you think it's going to go? Not to throw you under the bus. Where do you think it's going to go? And if it pauses here and gives us a little bit of a break, I love to go back to those support levels.
And Miles, before you answer that, I'm just going to throw this at you. I've said for a while now that I'm bearish silver, bullish gold until convinced otherwise. And I will say I've flipped bullish silver. I said it was going to take recapturing 3250, but the policy change, the run we've seen, I like that it took a little breath today, but I've flipped bullish silver. So I want to hear your take on that.
Good grief, quitter. All it took was one day, huh? Just
one day,
and I
man,
lose you
I've
to the
been
optimists.
Fared up for a long time, Miles.
Just one stinking day, and I've already
man.
lost you to the optimists.
You got to react if things change.
I'm pretty close, man. My thing with charting and the way I look at charts, there's 4 or 5 or 6 indicators that I really like and I kind of look for. And let's say there are 10 and I say, each one adds a 10% chance of something happening. So, for me, it's a checklist. Which on these, it's a pre-flight checklist before I'm going to say bullish. Yep. Like, have I checked the brakes? Have I checked the gas? Have I checked all these things? Mm-hmm. So there's a couple things for me on silver that constitute the checklist. The first one obviously was getting above the 2020 highs and staying there. So the first one's getting above the 2020 highs. We did that back in May.
And what was that level?
So that's back around 2985. Okay. That was August 2020, and then we double tapped it in January 2021. We touched it again in April of this year, and then we started to push above it in May. And we've sort of been above it, below it, above it, below it. And now it looks like we may be finally trailing our way up there. So, and it's not surprising that anytime you're hitting a hammer against a brick wall, you're going to pound through eventually, but it's very unlikely that you just blow right through something. You generally don't Kool-Aid man your way into the next trading range. It takes a little bit of a fist fight. Yep. And that's what we've been seeing over the last couple of months here. So that's step one. Step two is I want to see us, and I'll draw this on the chart here, in that we've had the top end that we made, which goes back to May when we did finally blow above the 2020 highs. The top end we made, which was around 3250. We built sort of a declining ceiling there. We needed to move above that ceiling. So that's number 2 on the checklist. We've now done that. So now we're at a 20% chance. Each one of these things on my checklist kind of adds another percentage. The third thing on the checklist is we now need to put in a higher high, which we have not done. So a higher high above the initial breakout high back in May. This is easier if you're looking at the charts.
That's the big one for me.
Yep.
Yeah. So I want to see us not just poke our nose, our sniffer above 3250. I want to see us put our foot on top of it.
Yep.
Now I'm 50, 60, 70% sure that we're heading to significantly higher breakout pricing. Because the only thing we can really do now is we got to go back and look for levels back in like 2011, 2012. Because that's the last time we were at these pricing. And as much as I like to talk about the concept of standing orders from previous levels, ain't nobody got a sell order that's been on the books for 10 years.
That's right.
Like at $38. Like that's not a real thing. So nobody's got that standing sell order from 10 years ago. So yeah, I haven't drank the optimism Kool-Aid quite yet on silver. I remain bearish. I'm optimistically bearish, because I do think we're starting to see us check some things off the to-do list to be able to argue breakout bullish move up.
Yeah, and I think one of the fun things about this, and we can end here, is that by this time next week, and I know this is an important thing for you, Miles, we will have the end of the month and end of the quarter. So, I mean, if silver can get above 3250, like you said, not just poke its head above it, but get its foot on top of it and close there on the month and the quarter. That would be what, like a 20% bump to your checklist?
That's going to be a pretty good bump. Yeah.
Yeah, and I don't care what gold does. For me to be bullish silver, because I'm going to remain a little bit bearish here until we do see that new high. I want to see the ratio drop below 80. The gold to silver ratio. Now, I'm a grateful bear because I am grateful that silver is where it is in this bearish trend that we've been in. It's still very strong. It's keeping pace with gold. It's driven the ratio down. It's helped breathe some life into the white metals aspect of the portfolio. I want to show one other chart here, and we'll get off of the silver, but that's when I'll be really bullish, is when we see that coincide. I love the thought of a week close, a month close, a quarter close. That would be really, really powerful, but also see the ratio cooperate where it's telling us, hey, silver is really getting some legs here and we've got room to run, because based on the way we structured our portfolio over the last number of years in a bearish silver cycle, we want to see that happen so we can get a ratio trade and end up with more gold. But I want to show you guys this gold to platinum chart, because we mentioned platinum just briefly. Don't sleep on that opportunity. This is something that Shayla, another advisor here, brought to my attention today, and it's really a powerful image for why you should be keeping your platinum. Miles, you talked about the fact that it has remained down, but look at how high. I mean, we look for these outlier events on gold versus silver or silver versus gold to the downside. Why are we ignoring the gold to platinum ratio? It may be that we're selling that platinum for gold later when platinum narrows that gap and you're picking up a bunch of ounces. We're talking 50% more ounces of gold if and when that platinum actually performance does end up shrinking that gold to platinum ratio.
Man, what a good thing to bring up, because we've been talking about, gold's at 2,500, platinum's still 1,000. Yeah, I kind of forgot gold's at almost 2,700 and platinum's still at 1,000. So guess what? We're at actually even less than that. So thanks. I'm glad you brought that up. I just pulled that chart up. Platinum is the third the price of gold. Platinum is one third the price of gold. It is 20 times more rare and one third the price. That is insane to me.
And keep in mind too, Miles, maybe you can pull this up on a chart and just show me some RSI, because unlike the white metals who have seen some good declines and some healthy trading, gold has been pretty vertical. It kind of hasn't taken much of a breather. I don't know if we're getting to those overbought levels on the RSI, but I would just keep that in mind too. And a healthy pullback is all I'm looking for, but that's all we need for those ratios to compress, is for silver to keep moving up. It doesn't even have to be dramatic, doesn't have to break through the new all-time highs, but it's closing the gap. If silver keeps going up while gold takes a little breather, bring it.
Amen.
You're completely right. I don't need to pull up RSI. You already know the answer to that question. This is what we call, you learned this term back in high school. It's called parabolic growth. And that is not sustainable. So I'm right there with you. I talked to a vaulted client of mine earlier today who's kind of in the same boat. He's been adding to his vaulted account for years, and he's got a little chunk of money that he's set aside. He's like, man, I just keep waiting. And I'm like, well, for someone like yourself who already has a significant metals position, I think you're fine keeping waiting. But you've already got your safety net in place. And I think maybe this is the thing I want to end on for the show this week, since we definitely don't have time to have the election conversation this week. So if you have your safety net in place, you can be selective with making the safety net a little bit bigger. If you have no safety net in place, the price of gold becomes irrelevant 10 years from now. I've been buying gold for 20 years. Tori, you're probably about 20 years in. Eric, you've been buying gold for 10 years. Name one price you ever paid for gold. I can't. No clue. I just know that most of it was a lot cheaper than it is now. So sure, in the moment, nickel and diming, $50 up or down, feels like a big deal. But I can tell you, man, 10 years later, when gold is 2 to 3 times the price it is now, you're not even going to remember. So if you don't have a safety net in place and you're watching the price of gold go up, this is not the time to be gambling.
I can remember because I just bought last week.
I bought last week too. I have no idea what
That's
price
the
it was
only
at
one I
because it
can
was in my
remember.
vaulted account and it bought it automatically. So I actually don't even know what I paid last week for my gold.
And that's very true, but I bet you that we all remember when we bought $40 silver. That one still
I
hurts.
have definite silver eagles I paid $45 for. That doesn't count. Way to ruin my point. Thanks, Eric. Oh yeah, I've still got my eagles I'm upside down on. Sorry, go ahead.
Well, that's going to do it for this week's Golden Rule Radio. As always, thank you so much for listening.
If you liked what you heard, let's hit some subscribe buttons and ring some bells, the old YouTube things. We really appreciate it. That helps us get the word out a little bit more. If you'd like to find some more info, we can be found on Twitter at ICA Gold. We're also on Facebook at McIlvaney Financial. Better yet, if you want to learn a little bit more about precious metals investing for your own portfolio, swing on by our website at McIlvaney.com. And nothing is ever better than having a one-on-one sit down with one of the advisor here at McIlvaney Precious Metals. Give us a call to schedule a time to speak with your advisor at 800-525-9556. Thank you, like always, for joining us each week. Hope you have a great week, and we'll see you here soon.